Hello, welcome to Futures Trading Demystified with Maverick Trading. My name is Rob Reinhold. It's nice to see you. Let me give you a little quick background about myself if you don't know anything about me. I like long walks on the beach. I am a Virgo. Actually, that's not true. I'm a Taurus. I don't know why I said I was a Virgo. Anyway, that's probably not what you wanted to know. I've been trading for 21 years now. I started back in 1997. I started as a day trader on the SO system and one of the very first direct access trading systems. And I got into options in the late 90s. I got into Forex and futures in the, let's call it 2003, 2004 area. And so I can't say that I've traded everything because that's absolutely not true, but I've traded quite a bit. So I love topics like this, futures trading demystified, because futures is one of those things that people think is very exotic, and they think it's very risky and dangerous, and they have all these preconceptions about what it is. And really what I want to do is I want to break everything down today and show you that it's not that big of a deal. It's not that mysterious. It's simply another thing to trade, and it's going to go up and down based on supply and demand. So that's really about it. So what I want to do is take you through in this session is take you through, okay, what are they? How do they work? We're going to go through a little bit of the history behind futures, and then we're going to talk about actually trading futures. And what I want to do is by the end of the session, not pump you up to where you run out and go do some futures trading, because that's not the purpose of it. But I really want to just illuminate exactly what it is and how you can eventually add it into your trading system and your trading plan. Because for some of you, there will be a place for futures, and there's going to be something that you do want to add into your trading plan. For some of you that aren't currently trading, maybe this is the thing that gets you interested in getting a little bit more serious about trading and start working towards putting together a trading plan and a trading strategy. So whatever it is, I want to basically take this topic and make it to where you have a good understanding of exactly what it is and where to go from here. All right, well, let's start off with what is a futures contract. Now, futures contracts, in my guess, have been around for thousands and thousands of years. Now, the very first futures exchange opened up, I think, in the early 1900s. So I think the oldest futures exchange, first of all, is probably not even around anymore. There's probably about 110 years. But in my opinion, people have always been doing futures contracts. And let me just take a basic futures contract. And this really all started around agriculture. So let's take two groups of people. Let's take a farmer and let's take a business like Kellogg's. Now, a farmer produces corn. Now, the farmer knows, okay, I've got to produce this crop. I'm going to, in the spring, I need to till the soil. I need to plant the seeds. I need to water the seeds. I need to fertilize the seeds. And I need to harvest. I need to process it. Again, I know very little about corn, so please excuse my ignorance if that's not how it works to handle corn. But in the end, the farmer says, okay, or estimates that growing corn is going to cost $4 per bushel. Now, again, I also don't know what a bushel is. We're going to talk about why that doesn't really matter. But $4 per bushel to grow for a season. So the farmer knows that at the end of all of that hard work, and that is hard work, and that is putting a lot of risk out, you're putting money out front, and that farmer has no idea what the price of corn is going to be in the fall when they go to market to sell their corn. And if it is $3 per bushel, they're going to take a big loss, and they may not have enough money to plant again next year. If it's $7 a bushel, then they're going to have a great year, and it's going to be a fantastic thing. But again, it's a big risk for the farmer. Let's take the other side. Let's take Kellogg's. Kellogg's makes their cornflakes. And again, they know that when they run all their numbers, that once corn gets more than $5 per bushel, it starts to really eat into their profits, and it makes it to where their product is no longer profitable. So Kellogg's needs to buy corn for less than $5 a bushel. So basically, these two parties come together and they adopt a futures contract. And that futures contract They agree that they're going to have a $4.50 price, and they both enter into the agreement. And basically what this says that in October, the farmer is going to deliver, again, whatever they agree upon, 100 bushels of corn, and they're going to deliver it for $4.50 to Kellogg's, and Kellogg's is obligated to pay them $4.50. So if you can see, this works out for both parties quite well. The farmer knows that he can sell this futures contract in the spring, and he's guaranteed to have a profitable year. Kellogg's knows that they can buy this futures contract, 6 or 7 months out, and they know that come the fall, they're going to have the right price for their product. Now, each one of these parties is required to put up a margin deposit. And this works just like in real estate when you make an offer on a house and you have to put up earnest money. It basically is saying, hey, I'm serious about this. I'm serious about this. I'm going to put some money on the line. I want to make sure that we all know we're obligated to fulfill this agreement. So that is just the basics of a futures contract. You've got the buyer, you've got the seller. There's a time and there is a price and there's an amount of whatever it is to be delivered. All right, now before we get into exactly what a future contract is and how it works, I want to go through this. And I've said this, and I know this doesn't make any sense, and I don't know any other way to say it, but I tell everyone, look, trading is trading. Trading is trading. In the end, everything you trade is simply a symbol. It's a current price, and that current price is going to go up and down based on supply and demand. Period. That's it. Now, one of my pet peeves, and this is a big one, and sorry, you're going to have to listen to my rant and rave here for a bit. When I got started in trading in the mid to late 90s, everyone on Wall Street, everyone said, hey, you cannot make money trading. You could only make money in the market by buying and holding and being an investor. And whenever I told people what I did for a living, they said, oh, you're just a gambler. Like, there's no way. You can't do it. It doesn't work. You've got to be a long-term investor, buy and hold. Well, it's funny how over the years, things have changed. We now have a show called Fast Money. We actually have a show on TV about options trading, and there's tons and tons of books and resources about trading. And now it's actually generally accepted that, okay, look, yeah, you can be a trader. But it drives me crazy that Wall Street, and I say Wall Street, but I mean the whole financial system, has really kept this idea of fundamentals. And I just cannot stand it when I hear on Fast Money or I hear Mr. Kramer say, oh, look, we like this company. We're going to trade this company because it's a good company. It's got rising earnings. It's got a good CEO. And that bothers me so much because I think to myself, what in the world does a good CEO have to do with trading? Trading, it doesn't matter what the symbol is. It doesn't matter. Your job as a trader is to make money from the price going up or down, period. What the CEO did for breakfast, it doesn't matter. What the product the company makes, it doesn't matter. All that matters is that you have a symbol, a market price, and that you are on the right side of the trade. And it drives me crazy that Wall Street is now mixed in this, okay, you can trade now, but you still have to know about price earnings ratios and this and this. No, you don't. As a trader, as a pure trader, all you care about is being on the right side of the trade. That's it. And again, it drives me crazy that they've wrapped this up. Now, here's why it drives me crazy, because what happens is people get into stuff for a trade, and hopefully you can see my sarcastic air quotes that I'm doing, and then it doesn't go their way, and then they use fundamentals to justify not taking a loss. So they get into something they're just going to buy at 50 and sell at 52. Next thing you know, it goes down to 47. And now they're saying, oh, you know what? This company's got good sales. It's got a good CEO. It's blah, 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 blah. No, as a trader, you take your loss, you move on. Period. So here's a great thing. Trading is trading. If you can trade one profitably, you can trade them all. Now, yes, they're all going to have some different terminology, liquidity, margin. We're going to go through all those things. But in the end, what you trade is actually not important. How you trade is important. And in this example, I always tell people this is like a car, driving a car. In the end, driving a car is the same in every car. You've got the steering wheel, you got the gas, the brake, it's the same. However, some cars are going to be different. Some cars are going to be faster than others. Some are going to have different bells and whistles, but in the end, if you can drive one car, you can drive them all. Now, the problem people get into, and we're going to talk about this with futures trading, is that some cars are quite fast, meaning they have more volatility and they have more leverage. Now, imagine you took your 15-year-old and you said you don't need to get the Prius, you don't even need to practice in the go-kart track. We're going to put you in a Lamborghini and you're going to have no problem driving. Obviously, that's not going to work out. It's no wonder people crash when they try these cars. So we're going to talk about futures. We're going to talk about how they work, but just realize it's just a little bit faster car. And it's mostly because of the leverage that Wall Street is willing to give them. But let's go ahead and jump into the terminology, liquidity, margin, all those things so you can get a good idea. But in the end, trading is trading, period. Whatever it is you trade, it's a symbol, it's a market price, and that market price is going to go up and down based on supply and demand. That's it. I want every one of you to remember that trading is trading. You have to just look at it purely like that. Once you start adding in all the other garbage that Wall Street wants you to do, it starts to muddy the waters, and you're no longer looking at trading the right way. All right, a futures contract has these four things. It has an underlying asset. It has a quantity of the asset. It has a delivery location, and it has a delivery date. All right, so we're going to go through these, but let's go ahead and just cover delivery location. Now, there's some old wives' tales. Now, again, they might be true. I doubt it. But there's an old wives' tale of a futures trader in Chicago who left some long oil contracts open over the weekend. And next thing you know, 3 months later, he had to take delivery of like 1,000 barrels of oil in his driveway. Now, that is it. Look, let's just pretend that's a story that happened because look, that's funny. And maybe back in the 80s that actually could happen. Don't worry, the brokerage accounts that you trade through, they are no way going to allow you to take delivery. You actually have to have a very special account to take delivery of the underlying asset. So let's not even worry about delivery location. That's part of the contract, but as a trader, we don't have to worry about that at all. What we do have to worry about is the underlying asset, the quantity of the asset, and the delivery date. So let's break these all down here. Let's take a look at the gold futures. So what we have again, the underlying asset. So if you want to see the underlying asset for gold, it has a symbol. The symbol is GC. So that is the underlying symbol for the COMEX gold futures. And then if you want to take a look at the expiration or the delivery date, that is Z18, which means December 2018. So as you can see here, we now have a symbol. We now have a symbol where we know that if we were to put in GCZ18 into a trading platform that has a feed to get the real-time quote on this, we're going to get the market price. It's going to say this is the market price of the gold December 2018 futures contract. Now, one contract equals 100 ounces. So 100 ounces of gold is what one contract equals. So every time you buy and sell one contract, you are literally buying or controlling 100 ounces of gold. Now, next up is a minimum tick. Now, the minimum tick, this is something, it sounds strange, but don't get too carried away with it. If you were trading a stock, stocks trade in dollars and cents, and we all get dollars and cents. So if you have a stock trading at $50.12, you know that the next move up is going to be $50.13. You know that. and then or if it takes a move down, the next tick's going to be 1 penny lower. So they just trade in pennies. Well, futures contracts trade in ticks. Now, when we talk about Forex trades in pips. A pip is 0.0001. That's a pip. So Forex trades in pips, and so every time it goes up or down 1 pip, that's just this number moving here. So in the futures market, each contract is going to have a minimum tick. So what that means is the price of gold, let's say the price of gold is $1,210.20. The next move on this is either going to be 12.10.30 or it's going to be 12.10.10. That is the minimum tick. It's going to move in basically 10-cent increments. Every symbol has different minimum ticks, and so you just have to learn that. Again, this is where Google is your best friend. Anytime you want any information like this, hey, what is the minimum tick on the COMEX gold futures? Google it, it'll tell you. What's the minimum tick on this? It'll tell you. Now, the value of 1 tick is $10 US. So that means, okay, every time this thing moves up or down on one contract, it's going to mean a $10 gain or loss. So again, if it moves up to 12.11.20, you're going to have a $100 profit. Again, that's going to be 10 ticks. All right, so again, this is simply how it works. As you see, we have not really gotten anything weird here because, wow, this is kind of how stocks move. Stocks have a symbol. You have a market price. And when they move up or down, okay, stocks move up a penny. The gold futures move up 10 cents every time there's a tick. Okay, it's still the same thing. Again, trading is trading. So let's look at the transaction. Now, this is where not just anyone can go and make this transaction. You have to get approved for futures trading. You need to meet some minimum requirements. You have to meet some minimum standards set forth by the broker-dealer and also by the government. But once you fulfill those requirements, you are now allowed and approved to trade futures. So if you put in an order that you're going to buy the GCZ18, so again, that's going to be the symbol you put in, and let's just say the current market price of that contract is $1,200. So again, you're going to take the contract size, which is 100 ounces, and every single contract that you buy is going to control $120,000 worth of gold. Now, this is what you really need to understand. Everything we kind of went through was just building up to this point. You need to understand that this is what you're trading, because if gold goes up 1%, if it just goes up 1%, you're going to make a rate of return. And I always tell people, look, when you talk about trading, everyone looks at trading in dollars and cents, and it is just the dumbest way to look at it. It's all percentages. It's all percentages. So again, if this goes up 1%, this is going to be a $1,200 profit. That's what it's going to be, $1,200 profit. If it goes down 1%, it's going to be a $1,200 loss. So when you are in any trade, if you are buying 100 shares of Apple, Apple's at 120 bucks, that's $12,000. You're going to make a percentage return on that amount. So this is really what we're talking about. This is what you need to know. You are controlling $120,000 worth of gold. Now, just like we talked about in the futures contract, you don't need to bring in the whole amount. And this is where futures get really exciting, and this is also where futures get really dangerous, is that your margin requirements are going to be lower. You're just going to need to put up the margin. You just need to put up a small risk deposit, not risk deposit, but a small, I'm trying to think of the real estate word. Anyway, you got to put up this deposit. So at Interactive Brokers, where we trade at Maverick Trading, the intraday is $3,100. The overnight, I got this backwards. The overnight is a little bit more. So all they're saying is if you see intraday and overnight, there's going to be an intraday period, which I believe is 8 a.m. Eastern Time to 4 p.m. Eastern Time. That's going to be the intraday. And then if you want to hold it past that time, they're going to have a little bit higher margin requirements. But basically, you would need $4,000. $4,000 to be able to hold this futures contract for more than a day. Now, all of a sudden, that gets exciting. Holy cow, are you telling me that I can control $120,000 with $4,000? This is what attracts people to futures. Now, here's the dumb thing. The people that are attracted for that reason, they probably don't have a lot of experience with trading, and they probably don't understand that, hey, trading is a pretty difficult game, and it takes a lot of time and effort and experience to get good at it. So what do? They go in with their $4,000, they buy one futures contract, and if this futures contract moves 3%, and gold can move 3% in a day or two, very easy. Gold today was up 1.5%. This could completely wipe out someone's money. Now, look, it didn't have anything to do about the trade. The trade was the trade. Stocks go up 1.5% all the time. Their stocks would go up 10, 20, 40%. We saw that crazy marijuana stock, Tilray. That thing, I haven't seen crazy activity like that since 1999. For any of you who didn't see it, put in the symbol TRLY. And this is a stock that started out in the 20s. It ran up to $150, and then in one day it had a range of $150 all the way up to $300. I had never seen a stock that had 100% move of its prior close. It's crazy. So stocks can move much more than this gold futures contract, but because of the leverage and because people don't understand it, this is where they get themselves in trouble. It's about leverage. It's about position sizing. It's about risk management. These are the things that we really preach at Maverick. And look, we always tell people, look, there are 1,000 ways to make money trading. By no means do we have the monopoly on how to make money trading and reading charts and doing some other things. There's so many ways to make money. It doesn't really matter. What matters is your risk management. Because what's going to happen, and this is one of my favorite things to show our new traders, and I call it my 10 trades analogy. All right, so let's say over the next month or two, or however much time, you're going to make 10 trades. That means that you researched it. That means that you looked at charts, you planned it all out, or maybe you didn't. Maybe you're one of those people that just clicks buttons and likes to lose money because of it. But you made 10 trades. Now, here's the irony. The only trades that you will take are the ones where you're convinced you're right. You're convinced you're right. Everything lines up perfectly. You've done your research. Now, we all know you're not going to be right on all 10. We know that. Now, here's the funny thing. I love telling this story. My first year or two of trading, if you ask me a question, Rob, do you think you're going to be right on every single trade? I'd say, gosh, that's ridiculous. Of course not. Of course I'm not going to be right on every single trade. Okay, what about the trade you're in right now? Oh, yeah, I'm definitely right on this one. I'm definitely right. Do you see how absolutely ridiculous that is? Of course, I don't know if I'm going to be right on my trades, but I know for sure I'm going to be right on this one. That's the thing, is we only take the trades that we're convinced we're going to make it on. But let's say that out of the 10 trades, and again, I love my 10 trade analogy, you're only going to be right on 6. You're only going to be right on 6. So that means on 4 of them, you're going to take a loss. And again, this is, not to get too deep into statistics, but your results are going to be distributed along the bell curve. So anytime you take a bunch of numbers or a bunch of results, you can put it into a bell curve. What the bell curve says, okay, well, 68% of your results are going to be somewhere in this range, 1 standard deviation. 95% of your results are going to be within 2 standard deviations. So in the end, what you're going to find is you're going to find a bunch of stocks or a bunch of trades where, for the most part, you're going to make a little money, lose a little bit of money. But you're going to have one really terrible trade. Again, even though you did your research, even though you did all your stuff, you're going to have one terrible trade. And then you're going to have one absolutely fantastic trade in there. This is where money management is really the only thing that matters. I'm a big believer at this point, 21 years later, that the exit is so much more important than the entry. The entry to me is almost not even important. It's the management of the trade, the position sizing. If you make this terrible one too big on position size, it wipes you out. So again, I don't want to get too much into trading because this is about futures, but hopefully everyone gets that 10 trade analogy. You're going to make 10 trades. You're going to be wrong on probably half of them. Maybe a little bit better, maybe a little bit worse. Maybe you're right on 7 out of 10. But you're going to have your 3 losers. And if you don't have a plan, then that's where people lose it. And I've always said people don't lose in trading. They don't fail at trading because they didn't know how to read a chart or they didn't know about futures. Now, it's very easy to learn this stuff. People fail in chart because they screw it up and they don't have a plan and they don't have systems in place. That's why people lose. Again, I haven't met one person that has said, I lost because I didn't know how to read a chart. No, people say, hey, I lost because I knew how to read a chart and I screwed up and I got bullheaded. I didn't cut my losses and it actually broke me. All right. Wow, I got so off on a rant and rave there. I'm sorry about that. All right, let's get back to this. What do we need to trade? Now, this is the question. And I get lots of questions from people, especially around Bitcoin. I got a lot of questions around Bitcoin when Bitcoin became popular. And here is what a professional trader needs in order to trade something properly. Number 1, price discovery. Number 2, liquidity. And number 3, a guaranteed counterparty. Let's go through these real quick. All right, price discovery. Price discovery is, do you know exactly where you can buy and sell it now? And are you going to know that in the future? That was one of the problems that we had with Bitcoin trading, is that Bitcoin trades on all these different exchanges. And the price on one exchange might be a couple $100 different than a price on the exchange you're at. Well, the question is, which one is the proper price? We don't know. We don't know which one is the proper price. So price discovery is just a big deal. When you don't know at what price the underlying asset is right now, or it's mispriced, that's going to cause you some issues as a trader. One of my favorite stories to tell about price discovery really happened back in 2008. So in 2008, credit default swaps were a new thing on Wall Street. They started about 5 or 6 years earlier. Now, a credit default swap, I don't want to get too far into this. It's basically an insurance contract that people sold and bought to protect underlying bond issues and mortgage-backed securities. Now, there was no market. There was no exchange for credit default swaps. If you wanted to buy or sell a credit default swap, you'd have to call your trading firm, your brokerage. You'd have to call Morgan Stanley and say, hey, you know what? I want to buy 10 credit default swaps on this. Now, Morgan Stanley, they had to call around to people they knew that were in the business. Hey, I've got a guy that wants to buy 10 contracts. Are you willing to sell 10 contracts? And they would have to call around, and then someone would say, yeah, I'll sell 10 contracts. But at what price? And then you would have to negotiate the price. And then you'd negotiate a price and you'd make the trade. There was no way to know what the price was until you got on the phone and called around. Here's the problem. In 2008, whenever someone wanted to try to sell a credit default swap, nobody picked up the phone. Nobody picked up the phone. There was no buyers out there. And so what happens is, in the financial markets, big firms have to do what's called mark to market. Anytime you're holding an asset, you have to market to the market price. Here's the problem. What was the market price on a credit default swap? Now, surely it wasn't zero. Well, some of them were zero. But surely there was a value to them. But how do you know what the value is when there's no market trading in them, when there's no trades? This is one of the things I really dislike about real estate, is price discovery. You know, your realtor can give you an appraisal. Things can, they can run numbers. But in the end, when you go to buy a house, and a lot of people are finding this out recently, is that they're seeing a house that's listed for $250,000. They say, "Oh, great. Well, let's go in a little bit low. Let's go in and put an offer at $240,000." Here's the problem. That house ends up selling at $290,000 because it's in a bidding war because there's so much demand. So do you see how even on that real estate property you didn't know where the price was? Now you did after the transaction went through and someone else bought it, but you didn't get a chance to buy it. Same thing when you went to sell your house. In 2009, let's say you wanted to or needed to sell your house. Where was the price? You had no idea. You had no idea where the buyers were, or if there even were going to be a buyer. Price discovery, I don't think people understand how big of a deal this is. Price discovery is huge. It's absolutely huge as a trader. Without it, I think it's going to get you in a lot of trouble in the end. All right, liquidity is next. Liquidity is just how many market participants are there, which is a huge deal that basically affects the speed of your order, the slippage of your order, and also the bid-ask spread that you're going to pay on that transaction. And then a guaranteed counterparty. This one's really big too, and this is, again, the reason why we do not like regular trading in Bitcoin. We do like the Bitcoin futures. We've approved our traders to trade Bitcoin futures because in the Bitcoin futures, there is a guaranteed counterparty. So there are exchanges out there that only trade commodities or only trade futures contracts. We've got the CME group in Chicago, the Chicago Board of Trade. We've got the NYMEX, the New York Mercantile Exchange. This is where oil and gold is traded. And then we've got the ICE exchange. So on these exchanges, you know exactly what the price is. They're very liquid, and there's a guaranteed counterparty. And what that means is that if there's some panic that happens in the market, the market makers must make a market in this contract. Meaning if you want to sell, you will be able to sell. Now look, that doesn't mean that the price isn't going to be dropping quickly. It doesn't mean that you're not going to get slippage on your order. But it means that in the end, there's a guaranteed counterparty that will and has to, by law, take your trade. So that's what you need to trade something. You need to know what is the price, and when I want to buy or sell, can I do it at a reasonable time without reasonable slippage? And you know what? As long as the contract is traded on one of these exchanges, then you're going to see very, very favorable ways to do it. So again, we love futures trading in this aspect, is that it's very easy to know the price. It's very easy to get in and out. And the great thing is these are open, I'm just going to say 24/5. Now, obviously, there's rules for everything. Some of the lesser traded futures contracts may have different hours at the exchanges. They may be closed for several hours during the day. But the biggest contracts, they're going to be pretty much open 23 and a half hours a day. So again, your brokerage is going to control when these windows are open, and also the exchanges are going to control that as well. But as you can see here, this gives you the ability to trade pretty much around the clock. Not that you should, but it gives you the ability to do it. All right, so let's get into the types of futures contracts. We've got financials, we've got hard commodities, and soft commodities. Let me start off on soft commodities. Soft commodities is mostly agriculture and farming, cattle. It's cotton, soybeans. I see absolutely no reason for anyone to trade the soft commodities. Every so often, I have a trader at Maverick say, "Hey, Rob, I want to trade the cotton futures." And I've said, why in the world, of all the symbols that you can trade, why would you want to trade the cotton futures? Well, and it's always because, like, well, I know, my father used to be a cotton farmer. Like, that doesn't matter. What does it matter? There are so many symbols out there. Here's the problem with the soft commodities that I just don't like. In the futures market, there's something called down or up limit. Now, we saw these kick into place in 2008 and 2009 when the financial markets were crumbling. There were nights where the Dow, the S&P, the Nasdaq futures were down limit. Now, what that means is once something goes down limit, they shut down all trading. They don't let any trades go through. It's done. No more trades. And then that's it. That's it. There have been some stories where there were some of the soft commodities that were up or down limit 7 days in a row. Can you imagine being on the sidelines and every day it opens up down limit and you can't get rid of your position again? And then tomorrow it goes down limit again and you can't get out of your position? So what we talked about, liquidity, it's just, that's the thing, is you need to be able to get in and out of your trade. Now look, these are stories back from the 80s and the 90s. We now have a much better functioning financial system. We've got technology, we've got algorithmic trading, we've got things that are helping this, but we still will have up or down limits on a lot of these things. And the soft commodities are the most vulnerable to this. Something like a freak storm comes through and wipes out all of the oranges in Florida. Again, I know very little about oranges in Florida, but let's say that happens. Well, look, any of you who've seen the movie Trading Spaces or Trading Places? Sorry, my wife watches way too much HGTV. It's the only thing on in our house. I cannot believe I just made that mistake. But look, I know some of you can sympathize with me. HGTV and Food Network, that's the only thing that's on in my house, and it drives me crazy. Look, nothing against Property Brothers, but I kind of hate them. I'm sure they're great guys. I've just seen too much of them. All right. So what could happen is, that freak storm comes through and there's a drastic move. So I don't see any reason for anyone, other than if you are a actual producer of the commodity, to deal in soft commodities. Now, hard commodities, metals and energy, they're just perfectly fine. I think you can absolutely trade those. Gold, silver futures, oil, natural gas, they're perfectly fine. But where you're going to see the most traders gravitate towards are the financials. Now, the S&P futures, the Dow futures, the NASDAQ futures, they are just like ETFs. And they actually were way before ETFs were created. Again, if you don't know what an ETF is, they've created a symbol called the SPY, which is the spiders. And that symbol will go up and down exactly in lockstep with the S&P 500. The futures contracts, it's the same thing. So you can literally go out and just buy the S&P futures contract. Now, they have different sizes. They have the big size, and then they have what are called the E-minis. Most people will trade the E-minis. That's where all the liquidity is. Again, if you're going to be trading the index futures, I would say look at the mini contracts. And again, if you want to know the symbols, go to Google. The YM is the Dow futures E-mini contracts. The ES is the S&P, and the NQ is the NASDAQ. Bitcoin futures, same thing here. These are simply financial mechanisms to follow certain other aspects or certain other assets. They actually have a home prices futures contract. So you finally have a way to hedge out the exposure you have in owning your home. So if you can go back to 2008, you saw real estate prices were crashing. You could literally have gone out and shorted or sold the home price futures contract, and you could have completely hedged out the loss that you had in your house. Now, look, that's a little bit silly. We all know that real estate is local. This is just a national number, so it may not have actually protected you. But you actually could do that. You actually could go and hedge the price of your house by trading the futures contract on home prices. And then there's lots of volatility products. We're going to talk a little bit about these volatility products. They're very dangerous. Here's the problem: is they've become very, very popular lately. And hopefully everyone's spidey sense is starting to tingle. The hairs on the back of your neck are starting to stand up a little bit. Whenever something is very popular, .com stocks, Bitcoin back in last November, December, short volatility trades, whenever that happens, I'm telling you, it's about to get wiped out. It's about to get wiped out. So these volatility products, they're very dangerous. I'm going to show you something that people don't even understand, that if you're trading any of the volatility contracts that are futures based, there's some real dangers in these that, again, like I said, most people don't even understand. All right, so let's quickly go through, again, everything. In the end, like I said, it's a symbol. So this is the most recent chart I have on the December gold contract. This is the GC. This is the one we've been talking about. And basically, you trade it. When it's going up, you go long. When it's going down, you go short. That's really all there is to it. So let's take a look at just some possible trades here. Again, everyone has a different trading style, but one of our favorite trading styles is what's called the low base. The low base is when something is going down. Now at Maverick, we are big adherents of trend following. I don't have time in this session, but I have spent so much time looking for that edge. Where is that edge in the market? And study after study after study shows that stocks that have been strong in the past tend to be strong in the future. Stocks that are weak in the past tend to be weak in the future. And that goes for every asset class. So here we have the price of gold was going down. Moving averages were headed lower. Price was headed lower. This is what's called a low base. It's one of our favorite setups. And you can see you enter off the break of the low base. There was a 52-point move from top to bottom. Now, obviously, you don't get the whole 52 points, but there was definitely an opportunity. Another one of our favorite strategies is called just a bear rally. And this is where things that are in a downtrend, they have bounces. Once those bounces are done, you can go ahead and enter a short. And again, there was a 40-point move from top to bottom on that move. So you can see, as a trader, you're just simply looking to pick your entry points. Here's another low base. It broke down off that low base. You can see there wasn't much on this because it set up another low base. So there's a small breakdown, maybe 10 points, a base for another 7 or 8 days, and then it had a $42 break. So as you can see here, as a trader, again, you're looking for these opportunities. We call them high percentage trades, where you're waiting for certain patterns to develop. You do not guess. You wait for the confirmation. You take your position, and then you manage your trade. So you can see there was quite a bit of signals here on the downside, and there was actually one more signal that just triggered about a month or two ago. And again, that one actually did not make a new low. So again, it had about a $12 move, and then we can see that it went sideways. So again, I don't have time to go through charting. Charting is not so simple as just a couple of squiggly lines. There's lots that go into it. But basically, the gold contract to me is showing me signs of bottoming. Again, the first thing is we have stopped making lower lows. Our highs now are coming up right around this 12.15 area. So 12.15 seems to be a point where people are selling this contract. As you can see, these lines here, the purple and the aqua lines, these are moving averages. The moving averages have always been above the price. You can see now we're starting to get into the price. We're definitely seeing some signs of bottoming here in the gold futures contract. Now, right now, to me, there's no trade here. There's no trade. Why? Because if I was to go long here, I'm guessing. I have no idea if this thing's going to go up. And in the end, when I do make my trade, I still have no idea. But I'm making a high percentage trade. I'm waiting for certain setups. There is also no short here. We've stopped going down. We've stopped going down. We're just simply trading in a range here. Now, again, you could trade ranges. We have some traders that trade ranges. It's not very lucrative. You end up making a lot more trades, a lot more commissions, a lot more time, and you're not really making any money. We tell people, look, just put this symbol on the sideline and go find something that's actually making a move. Put an alert. When the alert hits, when it goes above 12.15, if that's your alert, then go back to trade the GC contract. But for me right now, it looks like it wants to bottom, but there's definitely no confirmation whatsoever. But again, this is just how you trade this. Again, you put in the symbol, you enter the order. Again, this would be up to a $5,200 move on one contract. Just adding 2 zeros. That's going to be your possible profit potential on one contract. All right, now let's talk about Contango. Now, this is a funny sounding word. And I remember the first time I heard it, I thought, what in the world is Contango? And then I heard it, and I still said, well, what in the world is Contango? And then someone explained it to me, and I said, okay, so what is Contango? Now, look, I by no means am an expert in Contango. There are people that are much better at this than me. But in a futures contract, there's what's called backwardation. Now, obviously, the price today is called the spot price. Now, if you ever hear these terms, there is a gold market called the spot gold market. The spot gold market is different than a gold future. The spot gold market is I want to buy the metal now. It's not a futures contract. You're literally buying the metal now. That's the spot price. So what backwardation is that in futures contract, obviously the further out you go from delivery, basically the market says there's a little bit more risk involved, especially if it's, if you're looking at a commodity, oil commodity. If you're making a trade on a 1-year futures contract, there's going to be a little bit more uncertainty. So again, what happens is it gets priced a little bit higher. Now this is very similar to an option. As if you take a look at a time decay curve on an option, this is also very similar to that. But this is the normal movement of a futures contract is backwardation, where the spot price is a little lower, and then as you go further out on the time curve. Now there are people out there that will make these trades. It's called spread trading on futures, and what they'll do is they'll buy one and sell the other. Now look at this. There is a small profit here. Let's say they're going to make 15 cents here. If they buy this and sell this and just wait a month, there's going to be $15 that's pretty much guaranteed. Well, until there's something called Contango. Now, Contango is where this all changes. And Contango can go crazy. Now, let's say that there is a hurricane that's bearing down on the major oil producing area of the world. And it's going to be there in a week or two. And all the news announcements say this is going to be bad. It's going to knock out production. Do you know what's going to happen to the 1 month out price? It's going to spike up. Now everyone knows, okay, once the hurricane is over, they're going to rebuild and they're going to get production back online. And so what can happen is this 1 month futures contract, it's going to spike. And it's going to be so much more expensive than all the others. Anyone who did a spread trade here, they're going to get crushed. They're going to lose, and I'm just going to throw out some numbers here, $9.85. So what they do, they play this game where they're going to make 15 cents every time. Ooh, it's easy money, it's easy money, it's easy money. And then one time they get hit with Contango. How many times do you need to make 15 cents to make up for that $10 loss? So you could be right 50 times in a row and still lose money because of this situation. We saw this situation hit early this year in the volatility contracts. A lot of people found out they were trading stuff like the TVIX. The TVIX is the volatility futures contracts. They were trading the VXX, and they found out that, oh my gosh, things can go really wrong. They were out there trying to get their 15 cents. Short volatility traders, they're going after that small amount of money, but they got creamed, and a lot of them lost a lot of money. I mean, they lost everything. So this is the trade I think I'm the most worried about. Also, the people that do wide condors or sell naked puts on the markets, and they say, well, I'm so wide, I'm not going to be right 95% of the time. But again, you're getting a nickel. You're getting 15 cents in. All it takes is one move, and you're done. That's a big thing we talk about at Maverick, is never put yourself in a situation where you can be wiped out. Because somewhere in your life, there will be a move that goes against you that can wipe you out. If you put yourself in that place, you will lose your entire trading account. Now, my guess is some of you have already done that before. You put yourself in a situation where you could lose it all, and if you do that enough times, you're going to lose it all. That reminds me of one of my favorite sayings in poker. If you know poker terms, there's a play where you put all of your chips in at once. It's called all in. And there's a saying in poker that all in works every single time, but once. I love that saying. It works every single time, but once. And then you're out of money. So a lot of people are all-in traders. They put all-in trades where they're risking it, and eventually they're going to get a bad beat, and they're gone. So again, money management, so key. Which brings me to what I do like. Now look, I've got no problem with the futures. But on every single futures contract, there's going to be options. Now at Maverick Trading, we are an options trading firm, and we are a spot Forex trading firm. And we really like the use of options because options give you fixed loss amounts. They give you worst case scenarios. As I just talked about, people never think about the worst case scenarios. And there are people thinking, oh, I'm going to sell a put contract 10% below the market price. I can't get hurt. Guess what? 2007 and 8 would have wiped them out. Would have absolutely wiped everything out. It will happen again. So we're always thinking about worst case scenario. So instead of buying the December gold futures contract, how about buying options on that? Now, I don't have time to get into options. We spend a lot of time with our traders on options. I can't really go anymore, but again, the trade would be to buy one contract of the December 2018 1200 calls. Now, what that means is you have the right to buy the gold futures contract at 1200. So that means if the price of gold goes to 1300, you have the right to buy it at 1200. So that would be $100 difference. The market price of this is 23 bucks. So basically, your margin requirement is going to be $23 because one options contract equals 100. So again, $2,300. Now here's a great thing. That's it. That's the most you can lose. Let's say the craziest thing happens and the price of gold plunges. I don't even know what could make the price of gold plunge, but let's say they found a cooler metal. Sorry, I know that sounds dumb, but I've always had a problem with why people think gold has value. Gold has no value. Gold has perceived value just like your currency. Your $100 bill is a piece of paper. It's all perceived value, and once that perceived value goes away, it's not worth anything. The currencies have gone worthless all over the world in history. The Weimar Republic in Germany after World War I, they were using their paper money to start fires because it was worthless. Zimbabwe, worthless. I have $100 trillion note that's hanging on my office wall. I love it. It's $100 trillion. You know what it was worth? $7 on eBay. So it does have value. It's worth $7. But here's the great thing is that you completely control all the risk here. You know that the worst thing in the world happens, you're going to be out $2,300. If that doesn't fit your position size or your account size, then you can look at a different contract. You can maybe take a look at a 1250 call. Now the price of that one's probably going to be closer to $5. So that'd be $500. You could take a risk. Now, of course, those are going to be different trades. I don't have time to get into it. But the thing we love about options is that you can totally quantify exactly what you're willing to risk, and that's it. That's it. So if it gaps down, no problem. If it goes limit down, no problem. We don't care because with options, you've fully quantified the amount of risk you can take. And the great thing is it gives you a lot of leverage on the upside. So when you're wrong, you can lock in what your loss is. When you're right, you get exponential growth because it's multiplied by that leverage. Again, if this thing goes up to 1300, probably fairly unlikely it goes up there, but let's say 1300, you're going to make, probably 70 bucks on this contract, maybe 80 bucks on the contract. So you're looking at $8,000. So again, the trade is so much better using an options contract. So here's just an example. Now again, don't run out and make this trade because as I said, the price of gold has not triggered yet. But let's say that our point here is about 1218. That's our trigger. And at 1218, we want to enter a bullish trade on gold. Well, one of the strategies we like to use is called the bull call spread. It's different. It's a little bit different here than just a long call. But basically, we're saying, okay, we want the right to buy it at 1220, but we are obligated to sell it at 1240. It's called a spread, an option spread trade. And so basically, anywhere below 1220, the most you can lose is 300 bucks. Anywhere above, the most you will make is $700 up above 1240. So look at how controlled this trade is. This is a very controlled trade. Now, of course, if you want to change how big these numbers are, again, you can just, instead of one contract, you can do 2 contracts. You can do 5 contracts, 10 contracts. If you do 10 contracts, you just add on a 0. This is your risk reward on this. But as you can see here, if the worst thing in the world happens, you're going to have a guaranteed loss amount. Now, yes, you do have a cap on the upside. If there's some trades you do not want to cap on an upside, you simply do a different option strategy. There's many of them that can do that. But this trade is just so much better. It's so controlled. All right, you only have 300 bucks at risk. If it goes against you, if it goes for you, you can make up to 700. Imagine if you made that trade 1,000 times. If you make that trade 1,000 times, it's going to be much better than a lot of the trades that some people are making out there, where they're just buying it and putting it all in and hoping it works. This is a very controlled professional trade where you've quantified your risk. So we're big fans at Maverick for options. Again, our whole options division, maverickTrading.com, is really dedicated to these kind of plays. And what we do at Maverick Trading is we do basket trading. So we'll have one of those trades on. It'll be one of maybe 20 or 30 different trades we have on. So we'll have a bunch of trades going on at once, long on some, short on some, sideways on the others. It's just a really cool way to trade. It's really, really a great way. Most of you that are trading, you're putting all your eggs in one trade, and it's going for you or against you, and you're having these lumpy results. And again, I use the term lumpy, but you don't have these consistent growths in your equity trend or in your equity average. By doing basket trading, you're smoothing everything out. And what's happening is you're having more consistent, steady returns, and you're not having those big drawdowns. All right, let's finish this up with some hedging. Hedging is a great way to use futures. So, as I said, futures are great for hedging. If you have let's say you have a large portfolio. Let's say you have a large portfolio. Let's say you have $1 million portfolio, and let's say you're worried like you were back in 2008, but you didn't know what to do. So let's say your portfolio is most likely correlated to the S&P 500. So you own big cap stocks. So you want to find the most highly correlated futures contract. If you own small cap, you're going to want to do the Russell. But let's say your $1 million portfolio is most likely correlated to S&P 500. So what you need to do is you just need to sell the same amount. So right now, one futures contract of the E-minis, the ES contract, which is the S&P 500, is about 150,000. So you basically would sell 7 contracts. If you have $1 million portfolio, you would sell 7 contracts. At this point, you are long $1 million worth of S&P-like stocks, and you're short $1 million of S&P futures. You've completely hedged out your risk. Completely hedged out your risk. It's actually a really cool way to use futures, and it's really the way the professionals, all the money managers, when they want to protect their portfolio, this is what they're doing. They're going out and buying or selling futures contracts against their long positions or long positions against their short positions. So hedging is just a fantastic way to use futures contracts. But outside of that, when we get into trading futures, trading futures is a leveraged way to take a directional trade. Now, let me break this down. And this is where people, if you don't have a lot of exposure to trading, all they know is directional trading. I'm going to buy a stock at 50, and it has to go up for me to make money. Everyone gets directional trading. Now, some people know about shorting. Shorting is where you sell first and you buy second. So people that know shorting, they get it, okay, well, I can make money either way. I could buy it at 50 and it goes up to 55, I make money. I get shorted at 50, it goes down to 45, I make money. This is called directional trading. So directional trading, this is it. You're going in, you're picking your timing. Your timing has to be very good. You must have a very good plan, a very good system, very good money management rules, very good position sizing. But this is directional trading. Futures, I've got no problem with traders trading futures. At Maverick Trading, we actually have futures at level 3. The big thing is that the problem with futures is that with smaller size accounts, the position sizing is almost impossible. We just talked about a couple of futures contracts. The gold futures contract is $120,000 worth of gold. If you are trading a $3,000 account, there's no way to position size. Even if you have enough margin to enter that, you can't properly position size. You're going to get wiped out with a move. President Trump's going to come out and tweet something and you're done. You're wiped out because you weren't able to buy a half a contract or a fourth of a contract. You had to buy a full contract. An S&P E-mini contract is $145,000. There's no way for you to properly position size. So what happens is people get attracted to Forex because of, hey, I can take my $10,000, I can take my $5,000 or $10,000 and can control a lot with it. The problem is their position sizing is too big because they can't do half contract. So we make sure, hey, our traders, let's make sure you have enough capital. So again, at Maverick Trading, we back traders with capital, and once they prove themselves, we give them more capital, more capital. So at level 3, that's about $75,000 of capital. And that's where we say, you know what, you've got enough capital now that you can properly position size for futures. Now, again, we make our traders turn in an updated trading plan, make sure they show us that they do have a good plan for trading futures. That being said, futures options, have at it. Our level 1 traders have at futures options. It works the same way as equity options and index options. We've got no problem with anyone trading futures options right upon approval for our capital sharing program, where we back our traders with capital. Futures are a leveraged way to take a directional bet in the market. You have to have enough capital to trade futures. The irony is, futures attracts people that don't have a lot of capital. Does everyone see the irony? That's why I say, if you're going to directionally trade, trade Forex. Trade the Forex market. It's by far the best directional market. It has the best trends. It has the best moves. It has the best leverage. And you can position size to the penny. Sorry, not to the penny, to the dollar. You can get so granular. You can take a position of 10,421. I mean, you can get so precise on your position sizing that, hey, this is how much of this I'm going to control. I'm going to control $10,421 exactly. So you can dial in exactly your position sizing. So if you have a smaller sized account, to me, you should be trading in the Forex market for sure. So this way you can actually properly position size. So this is why, again, futures contracts hopefully have illuminated a little bit, shown you, hey, it's not so mysterious. It's a symbol. It moves up and down. It does take a lot of capital to trade the futures contracts. So you do need enough capital to trade them. But if you're interested in directional trading, I would push everyone, and that's what I do. I push everyone to Forex. Trade spot Forex. Much tighter spreads. It's open more. It's got more consistent trends. I love the trends in the Forex. All right, so let's wrap this up. We've got 2 divisions at Maverick Trading. We have our options and futures division. We also have our Forex division. And yes, at level 3 in Forex, you can also trade futures. But what you'll find, and I'm telling you this, you will find that you don't really want to at that point. You're going to say, you know what, I like the Forex trading. It's the same thing. It's trading. Trading is trading. Whatever the symbol is, it goes up and down. Some go up faster than others, volatility. Forex is the most liquid market in the world. It's perfect. It's beautiful. So again, we have 2 separate divisions. MaverickTrading.com if you want to check that out. And then our Forex division is MaverickFX.com. So Maverick and then just FX.com. All right, well, let me invite you to do a couple things since you were so nice to come out and spend a little bit of your time with us. Please join us. Again, we'll give you an invitation to join either our FX room, which is for our Forex division, or we can join our trading room, which is for our options division. Basically, we'll give you an invitation. We'll get you signed up, and you can join us. Boy, it says August. This is supposed to mean October. Wow, I got terrible times here. We still have our summer hours. All right, so again, 10:15 p.m. Eastern Time for Forex, and it's 9 p.m. Eastern Time for our options. We also want to offer you just a 7-day free trial. So if you want to check out what we have to offer, just so you know, all of our traders that we bring into Maverick, they have to meet what we call our qualification program. They have to pass tests. They have to develop a trading plan and submit it, and then they have to do 2 months of demo trading and submit that as well. After that, we back our traders with capital. So we want to give you just a week to go check it out. So go in and take some of our tests. If you're an experienced trader, let's see what you know. Let's see what you know, and let's see if you can pass some of our tests. Obviously, the more experience you have, the faster you're going to get through the whole program. But we also have training courses for people that are new. If you want to get into Forex or you want to get into options, we have full training to take you from step A to step Z, all the way through it. All right, so again, what's going to happen is after this, you're going to get an email from one of our recruiters. We've got a bunch of people. We have a lot of people in this session. So give us 24 to 48 hours to reach out and get in touch with you. Basically, we're going to say, hey, this is a recruiter. I've been assigned to you. What do you want to do? Do you want to join us for the trading room or the FX room? Do you want to take a look at our website for a 7-day trial? Or do you want to apply for a trading position? So they're going to reach out to you and give you that choice of what you want to do. All right. Well, that is all that I have. Sorry about these times. These times are incorrect. So our FX room is 10:15 p.m. Eastern Time. And our trading room for options is 9 p.m. Eastern Time. We go to summer hours from Memorial Day to Labor Day. And I obviously did not update this from the last time we had this session. All right, so next Sunday is going to be FX at 10:15 p.m. Eastern Time. And again, this is where what we do is we break down the week. We talk about the week. We talk about, hey, this is what happened last week, and we plan out what are our trades going to be for the week ahead. What are some of the things we're looking at? It's basically all of our traders get together every Sunday night, and we basically gear up for battle for when the market's open. And again, Forex is already going to be open at that time. We gear up and we get our plan and we get ready for the week. All right. Hey, thank you very much for joining me. If you have any questions, please stick around and just put your questions in the chat box and we will get to it and we'll make sure that we're here to the last person. All right. Thank you so much for joining me. Everyone take care. Goodbye.